right, I guess we should get going. Gotta figure out where everything is. All right, there's the music. I got rid of the music. Now I gotta find the chat, and then I gotta find the live stream software. I don't know where it is. Where the heck is it? I don't even know where the software is. I guess that means I don't even know if this is running. Hang on. What the heck? Where's that? Not there. Here it is. All right, good. All right, so let's get going. Welcome to ECB Day. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. What's up? Hey, my name is Wayne. We're going to do ECB together. Yeah, it's going to be really exciting. They're not going to change interest rates. Yay! But we have a press conference in 34 minutes, so very cool. So we'll do that. If you can, like, subscribe, comment, yada, yada, yada. 6 minutes. In fact, I have a timer going. And 2 minutes and 54 seconds. Would you like to know what's happened in the past when it comes to the ECB managing monetary policy as expected? 70% chance euro dollar falls. 70% chance USD yen goes up. What? Uh-huh. Here's my timer right there. You can also do dark version. Wait, it changed the whole, it changed it. It should be here. There we go. 1 minute, 48 seconds. Yeah, cool. Neato. 1 minute, 31 seconds. All right, so the market is expected to keep monetary policy the same at the ECB. So what should we do? We should probably point this down. And project this out. What do you think? Quick little scalp. All right. In this case, when you open an account at Traders Way, if you don't choose ECN, you can do fixed spread if you like trading the news. If you scalp news, I recommend that you trade with a fixed spread, not a variable spread. It's one way of looking at it. Or just go with your good old ECN. Oh, the coffee's good this morning. Take a look at it. Quite a dangerous trade, huh? Yeah, it's very dangerous. And all right, so we have downward movement. Remember, there was a 70% chance of that. What do you think? Was that helpful information? I'll show it to you. Huh. I have to contact the developer about that. Notice how it takes you back to a different thing. Interesting. 2 minutes ago. Neat. So we had our little pullback here on the 1 minute. Just a typical high volatility event-driven strategy. Let me zip out a little bit so you can see the bigger picture. We have about a half an hour until the ECB meeting. And then tonight we're going to meet and do the State of the Union address together as a community. It's usually a couple hours long, so it's pretty late. We're going to have to take a nap before, but I probably won't get that kind of time. But it starts at 9, which is right around when I go to bed. But it starts at 9, so it'll probably go to 11 p.m. Oy vey. But if you want to get together with us, we're going to get together for whiskey and cigars and watch the telecast together. What do you think? Smell like a plan? Let me mark the role reversal, too, on this one. No, so I discussed it in QuantBox this morning, Meta, where I think there's more risk than there is. I don't think there's any reward, and I think there's definitely some risk. I don't think anything could happen that would make the stock market rally, let's say. Because if Joe Biden is reelected, there will still be a split House and a split Senate. So if he announces today that he's going to issue, $5 trillion in stimulus, well, that ain't going to happen because it'll never get passed. Or if he decides to tax the rich and increase corporate taxes, Democrats will love it, but it's never going to happen, and it'll never pass. Okay, so it's a stalemate, so to speak, to the upside. Now, the risk, the worst case scenario. Joe Biden has a brain fart. He has a gaffe of some sort during the speech. That would possibly be bad for the stock market instantly. And it comes from this idea that it may not be fair, but this idea that the leader of the free world and the leader of the largest economy in the world and the leader of the reserve currency is off his rocker. And nobody is at the helm. If it's interpreted that way, that's not good for business. And that would be bad for the stock market, right? So, and is that possible? Yeah, it is actually. So substance, it's not what he says, it's how he says it, I think. And so it might just be a great opportunity for us to, have a cocktail together and watch it. And it's quite a show. Although he's not the world's greatest entertainer. But yeah, there could be some substance, but not in the content. Yeah. Yeah. Well, it's funny. Again, this will sound political. I really try not to be. I have my opinions, of course, but I'm just another dumb Canadian in the land of America. But I remember watching Trump State of the Union addresses. And he was really good. He really was. And it was a show, but he was good at it. And even the audience laughed at a couple of jokes that he made, side comments and stuff. And it was really good. And then the next morning, I read the media, and it was strange. It was like the media didn't even watch. And it was either radically pro-Trump or radically anti-Trump. And I'm like, did they watch the same show that I watched? It was really strange. Yeah. So they are worth watching. They are worth watching, but they have become more of a show than substance. That's why I think there's more to lose than anything on this one. There's nothing that Joe Biden can do to make it a real winner, except maybe the upside is he's razor sharp. I mean, it's good, right? Like, it surprises everybody where they're like, damn, this guy is strong. Like, this guy's going to, like, it just, I don't know. I don't know what that is. It's more of a feeling than anything, right? Like the world just says, oh my God, he's spry. But is that going to happen? I don't think so. So it's more like, I don't think anything of substance can move the market in a positive way. So now the risk is something goes wrong and we might need to handle that. So I'm actually short the stock market right now, just in case. Or if he announces he will step down. Yeah, but that wouldn't be the right time. Well, Johnny Dollar says the Republicans already released. Yeah, but don't make a big thing of it. And in particular, please don't when we're working together, everybody, let's try to do this. We all have our political views, and they all matter. There's a couple of ways of looking at it. First, we need to be traders, investors, and economists. More than anything, when we work together, right? And I try to do that as much as I possibly can. It's hard to separate the two, but the economic Economics is the study of scarcity, in particular the human behavior in response to scarcity. And one of the biggest things in an economy is to decide the economic structure, right? The structure of the economy. Is it going to be capitalist or socialist? And then if it's capitalist, how capitalist will it be? And the more you choose, let's say extreme capitalism has lots of negative downsides. And if you do weak capitalism, there's also extreme downsides. And you know, and the pendulum swings. So you have like Canada and the UK, and then somewhere in there you have, you know, Australia, New Zealand, and then you have the United States, and then, you know, Hong Kong. These are all, you know, different choices of economic structure. And what I'm trying to say is there's strengths to each, and there are negatives to each, weaknesses to each. And all we're doing here when it comes to like this political election in the United States is society is choosing which one. And there's just different strengths and different weaknesses, right? So I'm neither here nor there. I have my personal opinions. Like, for example, there are things with Trump that I agree with, but there are definitely things with Trump I disagree with. Okay? And now the great thing about the American democracy is they can easily and often do change their mind. You can go from Bush to Obama to Trump to Biden and back again. Okay? So just look at it as society is just organizing its economy. And one of the biggest ways is, you know, the strategy of transfer payments. So a government raises taxes to pay for public services. And the more public services, the more taxes that are going to be needed. Now, unfortunately, and both parties are guilty of this, they don't want to cut on public services, but they don't want to raise taxes, so instead they borrow the money. So the homeless shelter is paid for by your credit card. Okay, so, well, that's not cool. Okay? And Joe Biden, for example, this evening is going to recommend or suggest that if you reelect him, he's going to raise money, or he's going to raise taxes on businesses and on wealthy. Okay, well, that's a choice. And then the next question I would have is, okay, that's neither good nor bad. The question is, what are you going to do with the money? What's the plan for that? Right, and it made us as to send to the Ukraine, where you're like, well, there's sort of an esoteric benefit of, let's say, the stability of democracy globally. But it's hard to quantify the return on investment, right? Like, for example, if I was running for president of the United States, I would also raise taxes. Now, would I do it on the rich and businesses? Maybe, but not necessarily. I might want to make it more broad than that. So I might have some taxes like that, but then I might put a tax on, I don't know, gasoline, whatever. I would come up with an idea. And then I would take 100% of that money and I'd pay down the debt. And I would declare the goal of $5 trillion. Or maybe I can make it 10 trillion. Or 1 trillion a year for 10 years. Okay? And what'll happen is that return on investment is also a little bit esoteric. It's not instant gratification, but the economy and the government would be more stable and sustainable in the long run. We'd be more credit worthy. The corporation of America would be more profitable because our costs would go down and all that kind of stuff. So like it would make interest rates fall. But I would be clear, specific, measurable, attainable, realistic, and timely. Here's where it's going to come from. This is where it's going to go to. Here are the benefits, and here's when we're going to stop. You know, that kind of stuff. But I don't think we're going to get, and it's not because, you know, I don't like Joe Biden or I don't like the Democrats. It's just like in this venue, you're not going to get that type of information. They might say they're going to raise the money and then do something with it, but it'd be vague. Well, I see. Yeah, I see. Yeah. Well, you know, I don't think. No, whatever. So I go into this as an economist. I want to make money. I have bills to pay. Very important things to do. Might as well make some money, right? Lots of money. Lots and lots of money. I was looking at, briefly today, I was looking at buying a used Bentley. I'm like, ooh, a Bentley convertible with a Mulliner interior. I'm like, ooh, that sounds nice. And I'm like, I looked at the price. I'm like, ooh, that's affordable. And then I looked in the description, and the guy said he's owned it for 3 years and put in $33,000 in maintenance and repairs. $33,000 in maintenance in 3 years. He's spending $1,000 a month just on repairs. Now, my Mercedes was like that. And I'm like, pass, right? That's a lot of pips. Yeah, I should, Jordan, right? One of my dreams is that we do an in-person conference together. And one of the things I'll do is I'll rent a yellow, like Murcielago or something, and have it driven out onto the floor or onto the stage or something like that, and we can all get together and take group photos and stuff. Richard says Trump was good for the market. Well, in a limited way. So there was a time for sure. One of the things I very, very, very much disagree with is protectionism, Trump protectionism, and his negative impact on global free trade. I very much despise that as an economist. So, and as we look at sort of social infrastructure, I think the more the world trades together, the less likely we're going to kill each other. So the more we trade with China, the better China will be, and the better the United States would be, and Europe, and so forth. But like we tariffed the heck out of them under Trump. And then we also made it illegal to sell certain technologies. So when you fast forward to today, and this is happening like right now in China, orders to places like Cisco Systems have dropped exponentially, and to other types of software companies, not just hardware companies and software companies, because China's response back then, which was Article 79, was that Chinese companies need to develop this technology themselves. And then Chinese companies need to buy from the Chinese providers. And so now there are Chinese companies that make Cisco type products hardware and software, and it's all made in China. Now, there's no need to do that with free trade. And if you take the macroeconomics course, I show it to you. You know, what you do is you focus on specialization and free trade, and one country can do one thing significantly better than the other country doing its one thing, and then you trade, and both groups are better off. But if you're forced to do it yourself because the other company or the other country cuts you off, then you're forced to do something that is on the short run inefficient. But then on the long run, well, you make your own stuff and you don't need the other partner. So I would argue now that it's been probably, 6 years since that was enacted. I think it was 2017. So 7 years. We are now on the losing end of that. And it'll probably get worse, where now China doesn't need American stuff. They're like, we make our own hardware, we make our own software, and quite frankly, it's better than yours. But it all started with us saying, we are not going to give you our stuff because our stuff's better, and we think you're going to misuse it. And they're like, okay, well, we'll make our own crap, and now we don't have to answer to you. We can do anything we want. And so now we've lost control. So that's unstable. I'm not saying that anything bad is going to happen, but what I'm saying is when there was a symbiotic relationship, we had a steady state. And now, because there isn't a symbiotic relationship, we have an unsteady state, and the outcome is indeterminate. So I liked it better before, and I could go back and I could blame Trump for that. It's also inflationary. So now if the Cisco system sells half as many computer networking equipment as they used to, because China, let's say, bought 50% of their stuff, and I don't know if that's true, but I'm just making up a number. And so if 50%, if the volume now drops by 50%, that Cisco system manufactures, so they make half as much, so now volume drops by 50%, the per unit cost goes up. And so now if American companies only rely on American companies can only rely on American computer networking products, they're going to have to pay more money. And that is inflation. And so that always happens. It's just a simple basic model. But now we also have maybe an adversarial relationship with the second largest economy in the world. And that's not cool. That's unstable. Now, Meta says, I think Trump was trying to gain a strong position for the U.S. in the world. I do agree with that. I understand why he was doing it. But let's say he either didn't complete it or it wasn't completed properly. But a lot of his rhetoric, though, too, is very much protectionism. And I can tell you, as an economist, that never leads to anything good. We literally studied it at Harvard, where we studied the history of various economies in Central America. And it was, we studied a couple of things. Americans went in and, well, first it was the Spaniards went in and raped and pillaged the Central America. And then America kicked the Spaniards out, and then the Americans raped and pillaged. So a little bit of distrust, right? By Central Americans are like, dude, we don't like foreigners. Gotcha. So then, and then the socialist pig dogs went in there and had a much different message. They're like, hey, we're imperialistic powers are bad. Capitalism is bad. What you need to do is protect the worker and protect the local economy and take care of your own. And they're like, yeah, that sounds good, because the other choice was being raped and pillaged. So they're like, well, we don't like being raped and pillaged, so this socialism stuff sounds pretty good. So they take in all the socialist pig dog nonsense, which is easy because they're poor anyway. So when you go in and you're like, well, you're poor, how would you like to have money? Yeah, we'll give you money. Great. We'll give you work. Great. So what happens is they become socialists, which means nobody has money and nobody has work. And then the next idea was, well, then let's protect our jobs by closing all the borders, because it's not our, right? This is the government's point of view. It's not our fault. It's the evil foreigners doing this to us. We're not screwing up. It's foreigners that are bad. So then they close all the borders, and now you have socialism without any trade. And what happens is now you have nobody has money, nobody has work, and prices are extraordinarily high. It's like you couldn't get any dumber than being socialist with a closed border. The dumbest socio-economic choice you could, a combination of choices that you could possibly make. It's a lose-lose. Nobody ain't got no money, and prices are high. The only way to do that is, the socialist gives everyone equal, which means that if you happen to do well, it's taken away from you and given to someone that's not doing well. And then you end up like there's no incentive to do anything. So it leads to low productivity. But then when you close the border and cut off trade from foreigners, what happens now is you have shortages, and shortages push up prices. It's not that prices went up because everyone's rich. Everyone's poor because nobody's working. There's no productivity. But now you don't trade with foreigners, and your country's not being productive. So now you just have shortages. So if a company actually, like, if the factory produces some toilet paper, gee whiz, and there's a shortage of toilet paper, then the rich people get toilet paper. But what if you need disposable diapers? Well, your country doesn't even produce disposable diapers. It comes from a foreign country like the United States, but you don't trade with them. So the only disposable diapers are kind of smuggled in or black market, and they cost 3 weeks worth of wages to get one box of Huggies. In America, it's nothing. Right? You see, like, but these are all consequences, and it's very, very well studied. So we know definitely what doesn't work, and we definitely are understanding what the sort of the strengths and weaknesses of capitalism. Capitalism hasn't been perfected yet. We're still in a learning process, and we are getting there, and we know the strengths and weaknesses, and we're going to modify as we go, and it'll improve. But we definitely know, we meaning human society, definitely knows what does not work. Closed borders and socialism. You put them together and you get the worst case scenario. All right, we're about 1 minute away. I forgot I can pop it up onto the screen. Forgot about that. Let me do that. Add browser source, add source, make it a new source, call it ECB. ECB. Oh. It added nothing. Weird. It's there, it just doesn't show. There we go. Meta, I saw what you said. Yeah, I thought it when I said it, but that's not what I meant.
Good afternoon and welcome to the ECB press conference. On stage are President Lagarde and Vice President de Guindos.
This guy's so
My
funny.
name is Wolfgang Preußel.
Hey, Wolfgang!
We are, as always, in a hybrid format, so if journalists have a question, please turn on the microphones and the cameras. And with that, I'll hand over to President Lagarde, please.
Good
Thank
intro.
you very much, Wolfgang, and good afternoon to all of you who could make it to Frankfurt today. So, the Vice President and I welcome you to our press conference. The Governing Council today decided to keep the three key ECB interest rates unchanged. Since our last meeting in January, inflation has declined further. In the latest ECB staff projections, inflation has been revised down, in particular for 2024, which mainly reflects a lower contribution from energy prices. Staff now project inflation to average 2.3% in 24, 2% in 25, and 1.9% in 26. The projections for inflation excluding energy and food have also been revised down and average 2.6% for 24, 2.1% for 25, and 2% for 26. Although most measures of underlying inflation have eased further, domestic price pressures remain high, in part owing to strong growth in wages. Financing conditions are restrictive and our past interest rate increases continue to weigh on demand, which is helping push down inflation. Staff have revised down their growth projections for 24 to 0.6%, with economic activity expected to remain subdued in the near term. Thereafter, staff expect the economy to pick up and to grow at 1.5% in 25 and 1.6% in 26, supported initially by consumption and later also by investment. We are determined to ensure that inflation returns to our 2%
Is everybody on the list for
target in a timely
TRADARS.co?
manner. Based on our current assessment, we consider that the key ECB interest rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Turning first to the economic activity. The economy remains weak. Consumers continued to hold back on their spending, investment moderated, and companies exported less, reflecting a slowdown in external demand and some losses in competitiveness. However, surveys point to a gradual recovery over the course of this year. As inflation falls and wages continue to grow.
By the way, I've
real
decided to make a
incomes will
very,
rebound,
very
supporting
affordable
growth.
version of it for you.
In addition, the dampening impact of past interest rate increases will gradually fade, and demand for euro area exports should pick up. The unemployment rate is at its lowest since the start of the euro. Employment grew by
TRADARS.
0.3% in the final quarter of 2023, again outpacing economic activity. As a result, output per person declined further. Meanwhile, employers are posting
But even the
fewer job
super
vacancies,
premium version
while fewer
will be
firms
less
are
than
reporting
$100.
that their production is being limited.
I really
by
want
labor
this to be
shortages.
available.
Governments should
So,
continue to roll back energy-related support
In the long
measures
run,
to allow the disinflation
be all right.
process to proceed.
in the short run,
sustainably.
I need you guys to win.
Fiscal and structural policies should be strengthened to make our economy more productive and more competitive,
Less than
expand
$20
supply
a month,
capacity, and gradually bring down high
Eskimo?
public debt ratios.
Eskimo maniac?
A speedier implementation of the Next Generation EU programme and more determined efforts to remove national barriers to deeper and more integrated banking and capital markets can help increase investment in the green and digital transitions and reduce price pressures in the medium term.
This is what you're looking at here is a
The
premium.
EU's revised
Okay,
economic
it's a premium
governance framework
upgrade.
should be implemented without delay. So let's look at inflation. Inflation edged down to 2.8% in January, and according to Eurostat's flash estimate, declined further to 2.6% in February.
Well, Jordan, they're two different things.
Food price inflation fell again to 5.6%.
It's looking for
in
patterns.
January
It's not looking
and
for
4%
pivots.
in February, while energy prices in both months continued to decline compared with a year ago, but at a lower rate than in December. Goods price inflation also fell further to 2% in January and 1.6% in February. Services inflation, after remaining at 4% for 3 months in a row, edged lower to 3.9% in February. Most measures of underlying inflation declined further in January as the impact of past supply shocks continued to fade and tight monetary policy weighed on demand. However, domestic price pressures are still elevated, in part owing to robust wage growth and falling labor productivity. At the same time, there are signs that growth in wages is starting to moderate. In addition, profits are absorbing part of the rising labor costs, which reduces the inflationary effects. Inflation is expected to continue this downward trend in the coming months. Further ahead, it is expected to decline to our target as labor costs moderate and the effect of past energy shocks, supply bottlenecks, and the reopening of the economy after the pandemic fade. Measures of longer-term inflation expectations remain broadly stable with most standing around 2%. Looking now at the risk assessment. The risks to economic growth remain tilted to the downside. Growth could be lower if the effects of monetary policy turn out stronger than expected. A weaker world economy or a further slowdown in global trade would also weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households
premium,
becoming less
super
confident
premium,
about the future,
all upgrades,
and global trade being disrupted.
Will still be less than $100.
Growth could be higher if inflation comes down more quickly than expected, and rising
on the long
real
run,
incomes mean that spending increases by more than anticipated.
I should be able to get.
If the world economy grows more strongly than expected. Upside risks to inflation include the heightened geopolitical tensions, especially in the Middle East, which could push energy prices and freight costs higher in the near term and disrupt global trade. Inflation could also turn out higher than anticipated if wages increase by more than expected or profit margins prove more resilient. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment.
Yeah, my original idea was to charge at least double that.
Unexpectedly.
Or let's say what I need. Let's do it that way. What I need is to charge you double that.
Have risen since our January meeting.
Or I can be patient and just over the period of time
conditions restrictive.
Cover costs.
Lending rates on business loans have broadly stabilized, while mortgage rates declined in December and January. Nevertheless, lending rates remain elevated at 5.2% for business loans and 3.9% for mortgages. Bank lending to firms had turned positive in December, growing at an annual rate of 0.5%. But in January, it edged lower to 0.2%, owing to a negative flow in the month. The growth in loans to households continued to weaken, falling to 0.3% on an annual basis in January.
By the way, all this data she's reading off, I cover on the swing trading group every Tuesday. So we've read all this data. We already know all this.
In conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged.
Oh, good morning, Commander Kurtz.
We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. Based on our current assessment, we consider that the key ECB interest rates are at level that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. So we are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much for answering to my question. First question would be on the more abrupt revision.
How many people like this technology that we're looking at right now that reviews all the ECB events and then gives us probabilities of direction and time?
Have you also discussed
how many people love it?
Perhaps do too much, and by that risk that inflation is going to undershoot the target at some point in time? Thank you.
Thank you. Thank you very much for your question.
What's up, K-Dog?
Allow me to preface my response to your question with something that we discussed, which is a little bit unrelated to monetary policy this morning.
Did you know
which has to do with the topic
200
of
brokers
concern to many European
were offered the
institutions,
technology?
which is the Capital Market Union. So, as some of you will remember, the Governing Council had taken a view on Capital Market Union back in 2020.
And they rejected it.
When the Commission had published its action
They didn't
plan
want to
at the time.
offer it to their
And
clients.
given the momentum and the
I want you to
special
think about
efforts,
that.
Deployed by
200
deployed by the Commission to progress.
Did
Capital
not want to
Market
put
Union.
this in the hands of their
We
clients.
have decided to update significantly that statement, and we have
This
unanimously
technology has been
agreed
banned by
on
brokers.
a new statement which is more specific, which sets out the imperative of moving fast and making progress. So that statement will
So
be
if you're
available
going to use it,
before close of business
you
today,
need
but
an
will come,
ECN like Traders
after
Way.
all the monetary policy documents are actually
You might get booted off
made
the
available
platform
so
for
that we don't
making money.
mix the two of them. But it was a decision that we made after a good discussion on the matter earlier yesterday and a little bit this morning. So, on inflation, first of all, I would observe that we are on this disinflationary process and we are making progress. You know, we came from 2.9% in December, 2.8% in January, 2.6%.
Well, Sal,
in
it is
February.
the truth.
So there is a definite decline which is underway, and we are making good progress towards our inflation target.
Okay, I'm going to switch around now.
And we are more confident as a result. But we are not sufficiently confident, and we clearly need more evidence.
So here's my two gold
more
trades.
data,
We'll see if I can survive.
and,
I just hit
we know
today's
that
target.
This data will come in the next few months. We will know a little more in April, but we will know a lot more in June. So this is really what we have determined during our discussion this morning. And as usual, we have proceeded with a review of the three criteria, which is, you know, the inflation outlook, which, as you will have noted in the monetary policy statement, has been slightly revised, a bit more for 24.
Come on,
granted,
Baba!
but slightly both for headlines and core in the next 2 years, 25 and 26. But we feel more confident about those projections. The second element that we look at, as you know, is the underlying inflation.
Yeah,
And
maybe you'd
on
have to
that
just
front
find a
as well,
different ECN.
We are seeing a narrowing of the range between the various measures that we use. We are also seeing a general moderation, with one exception. I'll come back to that if you want. We have looked carefully at the strength of monetary policy transmission.
TRADARS
three components
and
that we are
QuantBox. Here, I'll show
very
you.
keen to check carefully and to monitor meeting by meeting to see what information it delivers. And it's clearly a positive signal, but certainly not enough of a series of signals to make us confident enough yet at this point in time.
Thank you, Madame Lagarde. And the next question goes to
So why am I buying gold?
of Bloomberg News. Alexander, please.
On February
Taking
23rd,
my question, just
QuantBox
to follow up,
said
you you
gold
will
is
know a lot
bullish.
More in June. Was this the majority view in the Governing Council that you will not have enough information?
okay,
in
February
April
23rd.
to be ready for an interest rate cut? And then secondly, you're clearly very focused on wage growth. Can you be a bit specific how much further it needs
Okay,
to slow
this
down
is
for you to
February
be comfortable,
23rd.
with an interest rate cut?
QuantBox
I
said
think there was
start buying
general
gold.
broad
So
agreement about
just
the
showing
fact
you how
that
to
we
do
will
it.
get a lot
That's
more data
where
and a lot more
QuantBox
information
said-
in June. That's
well, this is where QuantBox
that's
turned
a
bullish on
certainty.
gold.
I think there was also a very broad agreement around the fact that
It was
we will
it was
not change our
a week and a
views
half
on
early.
one single data. And what
A week
we
and a
are
half
seeing
early.
in the data at the moment
better than a week and a half
are
late.
indicating certain movements, directionally good, but it is not strong enough and durable enough for the moment to give us sufficient confidence. So that was a generally accepted sentiment around the room, and the decision that we made was a unanimous decision, by the way. you are correct that while we continue to look at the three components of the inflation outlook,
It's not bad, huh? Look at
the
it.
underlying inflation and the strength of monetary policy, there is two components that we are particularly vigilant about, and those two components are the wage evolution as well as the profit evolution. Unit labor cost, unit profit are two items that we will be particularly attentive to and will continue to be attentive to. I mentioned that in the underlying inflation measurements, there is one which is not moving in the same direction as the others. The others are generally declining. And
Well, Eskimo, it's more like, how did traders know?
Narrowing as well. But there is one that is not declining, and that is domestic inflation. Domestic inflation is largely informed by services, which itself is, for most services, not all, but for most services, labor intensive, and therefore very sensitive to wage evolution. So those are the two components that we will particularly zero in and try to be laser focused on to see whether there is confirmation or not of this beginning of moderation that we are seeing on the wage front and confirmation of what has been observed on the profits.
So we're on a price that I
profit
suggested might be a buy
absorb and
zone.
act as a
I
buffer,
suggested it
for
yesterday.
the wage increases. I mean, we will have the Q4 numbers for CPE, for compensation for employee per employee tomorrow. Our assessment for the moment is declining relative to the third quarter. I think it's a conservative assessment given the various other elements that we try to look at. We look at some backward-looking elements, but we also try to be as
an average of
forward-looking as we can by, really following
seasonality
very
is
carefully
seasonality.
all the new agreements that are signed and
show
how
you
terms
what
and conditions will
it's
apply going
doing.
forward.
Thank you. And the next question goes to Aude Kozelek of BFM
This is what
Business. Aude,
Quantbox
please.
is doing to make that decision.
Yes, thank you for taking my question, Madame Lagarde. Underlying inflation is one of the three criteria you look at, and the only one that remains above 3%, at least at that current time. It's forecasted at 2.6% for this year. Is it a level at which you are comfortable to cut rates? And second question, a few days ago, Mario Draghi tells in a speech in Washington that a Eurozone need low capital cost to finance huge investments. Do you agree with that? And what do you think about the fact that these investments in transitions may be delayed because of high rates?
Morning, Elu.
Thank you for your question. On, I wouldn't
Can
say
I
that
use
underlying
traders for long
inflation is
term?
the only,
Yes, it does
figure
that.
is,
It looks at
above 2%.
daily and even 2 day.
We try to look at the
Yes.
inflation outlook, which includes, of course, the headline inflation, which is the one that, under our strategy review, we have agreed is the compass that we're using. We're also looking, you rightly say.
Okay, so that's
at
what
the,
Quantbox thinks about
inflation
gold,
without
just so
energy
you
and
know.
Food, otherwise called core inflation. But we don't only look at core. We look at other measurements of underlying inflation to try to, remove the noise from the signals and try to really measure each and every time what is going to be the best indicator to give us the measurements of what is to come. And but I wish everything was, closer to our target. We're not there yet. We are not there. Even on headline inflation, we are still projecting 2.4, which is a revision from what we had before, but we're still at 2.4 in 24, and we are at 2% in 25. And correct, underlying core inflation, core inflation is at 2.6 in 24, and then moving to 2.1 in 25, and finally reaching 2% in 26. I'm not here saying that we will wait until we are at 2% and that we see 2% to
target
take a
was
decision.
perfect.
This is
Look
not
at that.
what
It's
I'm
crazy.
saying here. But in terms of projections, both headline and core, this is what we are seeing. We are all looking forward to the two Italian reports, if I may say, because there will be a report by Enrico Letta on the single market, which, would, if fully implemented, would certainly deliver more growth than we have at the moment. And we're very much looking forward to the report of President Draghi on the competitiveness of Europe, which is obviously a major topic going forward. Now, I'm sure he will be making recommendations, and I will wait until we have the report to react to his proposals. But, you know, we have a mandate, we have a mission, we are determined to reach our 2% inflation target in the medium term, and we will be riveted to that.
Thank you, Madame Lagarde. And the next question goes to Balazs Korani of Reuters. Balazs, please.
Let me have a sip of water first.
Yes.
Good afternoon, President. Since our last meeting here, market expectations have gone through a serious revision. There's been a big repricing. How well is the current market pricing aligning with your own views? Are you happy with what's been happening in the market? Is this a better reflection of where you think policy might be going? The other question is about the framework review.
Yes, but that's a premium service, Andrew.
Standing now, where is it going? What's the next step?
But the answer is yes.
Timeline?
It'll email
And
you.
is the minimum
But not
reserve ratio
specifically when that
question?
one specific pattern. No.
Thank you much for the two questions. You know, I've tried in the past to refrain from passing judgment and commenting specifically on market expectations. I just note that it seems to be converging better, but that's, you know, everyone has to do their job. They do their job, we do our job. We look at
So this is
three
active
elements.
now.
We look at our projections.
4-hour
we try
chart,
to
pound
anticipate
Swissy.
the impact of our monetary policy, and that's how we make decisions, not by
But you're looking for more of a
being
Gartley
determined by
pattern.
what markets.
So we can do
consider.
this one.
So in terms of the operational framework,
Here's one Aussie
we
dollar
have had,
day
a
trade.
discussion short,
So
of
someone
course,
asked
because
about
the
day
the
trading,
main
yeah?
agenda yesterday and today was monetary policy, but we had a discussion yesterday morning, on the operational framework to
It's pretty, right?
narrow areas of discussions and arrive at a platform that hopefully will be a consensus between the governors.
Here's another
My,
one.
Strong expectation is that
Pound
it will
dollar
be
4-hour
completed
chart.
on the occasion of our meeting on March the 13th, and it will then be
That's probably closer to what you're
reviewed,
asking for,
published,
right,
explained.
Andrew?
I know that our communication department has some
These
ideas
are
as to how
still
to best
emerging,
do
though.
it, because it is,
This is
I
your
can assure
butterfly
you,
emerging.
a highly technical matter. Some of you are fully versed
But it drew this
in the
4 days ago,
sophistication
Andrew.
and the delicacies of operational framework, but it warrants a good review, good explanation. So I hope that you know, March the 13th will be the date when we go out with the operational framework. That will be, you know, part of what is being announced.
Thank you, Madame Lagarde. And the next question is for Martin Arnold of the Financial Times. Martin, please.
Hello, I have two questions, Madame Lagarde. The first one is about the pace at which
I don't see any that are actually open
normalize
right now, though.
policy once you do start cutting rates. Some of your colleagues on the Governing Council have said they think that it'll be a
I don't see any
gradual
open
pace, and there's
Gartleys.
the benefits to doing that. What do you think gradual means in that context? Do you agree with those? The second one is a bit different.
Those are emerging, but I
There
don't see
have
any
been various
active.
proposals put forward to utilize the frozen assets of the Russian central bank to
No,
fund
there's
in
none
some
active.
way the Ukrainian government and their defense against the Russian aggression. What do you think about that?
Thank you for your two questions. On your first question, you know, I would use the analogy of seasons and episodes. We are still in the holding season. We will move to the restrictiveness season. That will take a while.
It's nice,
And
right?
once that season is over, we will move into a normalization season. But if that's
Yeah, well, he
definition
doesn't
of
have any stop
gradual,
losses,
so
Andrew.
be it. But I would not commit to any kind of pace, rhythm.
He only has to be right on direction.
Magnitude, because we will continue to be data dependent. We will continue
not the
to
pattern.
observe, how the economy evolves, how the labor market moves, how wages moderate, impact of tightening on the financing of the economy. And that all these factors will be taken into account to determine future moves. On your second question, it's a matter which is under discussion at the European Commission level. It's a matter which is highly debated within the G7, which is a complicated issue which has legal ramification. And while there is no doubt in anybody's mind, I think, that Ukraine will need significant financing for its completely legitimate reparation program as a result of this aggressive and unjustified war by Russia against Ukraine. The financing, the sources of financing, the terms under which it is deployed by those who will support Ukraine need to be agreed and need to respect the international legal environment in which we operate and be particularly attentive to the international monetary order and the rule of law which has been enforced for decades. There are interesting propositions that are being reviewed concerning the interests generated by the proceeds, such interests belonging actually to Euroclear, which could possibly prosper, but that's clearly work in progress on which we have no final say. It will be for the leaders to decide what happens.
Thank you. Turning now to the online participants, I'd like to give the floor to Fabrizio Goria of La Stampa. Fabrizio, please.
Thank you, Wolfgang, and thank you, President Lagarde, for taking my question.
You're back testing, Jordan.
Actually.
You're back testing
So
buying
the first
dips.
one is, do you see any possibility that the Federal Reserve
In an uptrend?
decisions could affect the ECB moves? And the second one is about the commercial real estate market. Do you see any vulnerabilities in the European CRA market, considering the stress that we're seeing in the United States? Thank you.
Thank you very much for your question. On the mandate that we have, the mission that we have, the ECB acts independently, and we will do what we have to do when we have to do it. Obviously, we are mindful of the international environment in which we operate, but if the conditions are satisfied, if our diagnosis is that we have been restrictive for long enough to be sufficiently confident that we will reach our 2% targets, we will make our decision. I know there is writings here and there and views about the order and the sequence and reference to previous episodes, but I really think that we have to act in accordance with our mandate. The second question, if I may, dear Vice President, I will pass it on to you. Not that I don't want to answer, but you're far more qualified than me.
Well, good afternoon. Commercial real estate, as you know perfectly, is something that we have reiterated as one of the main risks for financial stability in the euro area. We have seen an important reduction in the volumes of transactions and the transactions in commercial real estate, even before starting the tightening of monetary policy. And we have seen as well, a decline in prices. But what I can say with respect to commercial real estate that I think that is relevant is first that the exposure of the European banks to commercial real estate is quite limited. If you look at the figures, commercial real estate credit amounts something close to 5% of the total assets of the European banks. But the problem is not the average. And the problem, and this happens quite often in economics,
It's at the
is the
extreme.
disparity around the average.
There you go.
And here, there are
We call that
some,
variance?
some banks that have, a higher exposure and a higher concentration in their portfolios, in their balance sheets
Yeah, so average is not
commercial
important.
property, to commercial real estate. And this is something that, we have been monitoring very closely. We have not seen so far any sort of, let's say, widespread contagion because of the evolution of commercial real estate. We have indicated several times that the exposure of the non-banks is much bigger, is larger than the exposure of the banks. So I repeat again, this is something that we have been looking at very carefully, and is one of the main risks for financial stability at present.
Thank you very much, Vice President and President. The next question goes to Santi Pinol of Market News International. Santi, please.
Thanks. Good afternoon, President Lagarde.
Good afternoon.
My question is, what would be the ECB approach if we see that inflation remains sticky around this 2.5 area in the following months? It would be like any changes? In other words, how much growth are you willing to sacrifice for a small deviation? Another question is, unit costs are partly being absorbed by profits. Is that your view that this will continue in the future? And do you think it will be enough to offset the inflationary impact of wages increases? Thank you.
Well, thank you for your two questions. It's not a question of sacrificing growth. And I would just remind you that in our projection, while aiming at reaching our target,
Notice that we
timely and
hit
in a
target,
sustainable
huh?
manner, as
think
our
we did.
projection indicate, we also
Yeah, sure did.
project recovery.
We hit peso
during the
target
second
for the
half of
month.
2023, and more importantly,
March is over, everybody.
2024,
Time to go
and
for
more
Ramadan.
importantly, in 25 and 26. Our projection is 1.5% in 25 and 1.6% in 26. So what we are really seeing is a slight delay of a process that we had anticipated. And we stick to our projection. Maybe you will have observed that recently our errors in our projections have reduced significantly, and they certainly make us feel more confident, not sufficiently confident yet, but more confident that we will reach the target. Your second question was about the unit labor cost, and you suggested that that unit profit cost would absorb, or was absorbing, I don't know exactly how you put it, but you assumed that it was absorbing all the labor cost. This is not quite the case yet, and we have seen some encouraging numbers in the late part of 23 and earlier part of 24. This is really one of the hypotheses that we made for our projections.
So we have silver going
our
up.
Projections are predicated on that precisely. We want to see that movement confirmed, both moderation of wages as we anticipate, but also the reduction of the squeezing,
today's
if you will,
day trade.
of profit
Our
margins.
target is
so that the
24.70.
unit profit cost absorbs
24.71.
part of the unit labor cost. Thank you.
How many people
Thank you,
here trade
Madame
silver?
Lagarde. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Thank you. I have two questions, if I may. Even if the decision was unanimous, did anyone at the Governing Council suggested that cutting rates today? And the second question, is there a huge difference between cutting rates in April or doing so in June? I mean in both in terms of economic pain, but also on the amount of that data you will have for that decision. Is there really a difference? Thank you.
But thank you. Those are really two good questions. So first of all, we have not discussed rate cuts for this meeting. Not.
Oh,
What we have
whoa,
done
whoa.
is
That
we
just
have
happened.
just begun discussing the dialing back of our restrictive stance But of course,
Whoa.
we need a lot more information coming in.
That's interesting.
In the
Did you
next
hear her?
few months to be sufficiently confident. And your second question related to the degree of information. Well, when you look at what will be published, what data we will have, both in terms of activity, in terms of wages, in terms of profit, we will have a little in April, a little. And we will have a lot more for our June meeting.
Thank you.
Yeah, silver's cheaper to
Because we are
trade than gold.
data-dependent, and we are adamant that we
Retail
will be
gold is
data-dependent.
what I call it.
Turning back to online participants, I'd like to give the floor to Tom Fairless of the Wall Street Journal. Tom, please.
Good afternoon, President Lagarde.
Good afternoon. No, good morning.
Good morning. I had two questions on the sort of a US angle. Firstly,
What a knucklehead, huh?
you know, investors are betting that the Fed and ECB will both start cutting around June and at a similar pace. And given the different economic landscape on both sides of the Atlantic, do you think that's reasonable that they should be expecting that with inflation and growth
He
lower
thinks
in the
that
Eurozone?
is professional.
And secondly, the language that you've used today is similar to what we heard from Fed Chair Jay Powell yesterday in terms of there being no rush to cut rates. And notwithstanding what you said about your...
Well, that's how we do it at journalism school.
Does it broadly make sense for major central banks to lower interest
All
rates?
right. They didn't even discuss cutting. So if you thought they were going to cut
Well,
next
thank you so
meeting,
much
somebody
for
here
your
said they
question,
said
but,
they
in a way,
said they
I
thought
think I
that.
addressed it earlier on
Well,
when
that's
I
probably
explained
wrong.
that the ECB is an independent central bank and will act independently. So we will decide on the basis of the three criteria that I have mentioned earlier, on the basis of the measurements that we have, the projections that we have, the additional data that we need. We will determine what action we need to take. And that will be done independently from what my colleague from the Fed decides to do. As to whether or not investors are reasonable or not for me to say. What I hope we can do ourselves is be attentive, monitor carefully. Once the data confirm that we are sufficiently confident to reach our 2% target in the medium term and make sure that it will be sustainable, we will act. That's really what I can tell you. By the way, I didn't say that there was no rush. Remember? I said that we did not discuss cuts for this meeting, but we are just beginning to discuss the dialing back of our restrictive stance, provided that we have enough and certainly more information to be sufficiently confident.
Thank you, Madame Lagarde. And another question for online participants from Eric Albert of Le Monde. Eric, please.
Thank you very much for taking my question. I just wanted to come back to what you mentioned at the beginning, the loss of competitiveness of Europe. How permanent do you think it is? How worried should Europe be about that? And then coming back on wages, can you explain a little bit on your thought about it? I mean, you said you don't have enough data for now, but I mean, what kind of data do you need to see to be confident enough? What kind of level do you want to see? And isn't some kind of catch-up of purchasing power needed actually for the European economy?
So thank you very much for your two questions. On the first one, I think that we will learn a lot more on competitiveness and how dramatic or not dramatic it is when we read the report by President Draghi. But you can observe that Europe has lost competitiveness in a durable manner for the last couple of decades, and that was accentuated certainly during the financial crisis. So it's one of the reasons why the Governing Council was of unanimous and very strong support for Capital Market Union to be rolled out, obstacles to be removed, supervision to be strengthened, and capital to be kept and made to work at home in Europe rather than elsewhere. It's not the reason, the response, but it's certainly one of the response which matters to us because it is also conducive to transmission of monetary policy in a slightly different way. Your second question, look, when we look at the underlying inflation and the measurement of underlying inflation, there is one obvious outlier in the measurements, and that is domestic inflation, and that is services. So you have to get under the skin of that and determine what is behind it and what drives it up. Clearly, it is wages, and because of this determination to avoid what I've called the tit for tat on previous occasions, we are also very attentive to profits. So it's the combination of the two. I'm not suggesting that wages should decline or that wage growth should be dampened. This is not what I'm saying. I'm saying that it's a major component of services and domestic inflations. Services is moving just a tiny bit. It was at 4% for the last 3 months. It's moved to 3.9%. Domestic inflation is slightly up. So we have to be specifically attentive to wages. And as many of you know, and as I'm sure you know,
stock market's open.
A lot of the indicators that we have, a lot of the data that we receive are a bit outdated. We will get the Q4 number tomorrow, which is more than 2 months after the end of the quarter. So we have to look at other indicators as well. We have our wage tracker, which sticks to all the agreements that are negotiated and signed. There is about a third of the employees that are covered by that wage tracker, of which the contract will stop being covered by an agreement as of now or at the latest in March. So we need to have that as well. We look at Indeed, as everybody does as well. And all these elements are showing us that there is an element of moderation. So growth is moderating. It's not going up as much as it did in late 22 and in the course of 23. It's the growth of it is moderating. So that's what we will be looking at very, very carefully. The fourth element that we also pay attention to is the corporate telephone survey, or the SMA as well, to hear from the corporate employers what is the labor shortage, how much hoarding do they have, to try to anticipate in a still tight labor market where wages are going to go.
Thank you, Madame Lagarde. And the next question goes to Minami Takeru of Nikkei. Minami, please.
Good afternoon, President Lagarde, and thank you so much for taking my question. So let me ask one question for better understanding. This is about wage growth and inflation. I think that even if wages continue to increase, the declining trend in underlying inflation may continue. It's just a possibility, but in this case, which one do you consider more important to decide to cut interest rates? The declining inflation trend or wage growth rate? Thank you so much.
Thank you so much for your question, but we will be looking at all of that, because
so I'm trying to decide whether I should close my hedge or not.
The inflation outlook, and that tells us what we should expect on the basis of the projections that are prepared by staff. And that indicates clearly that we are in this disinflationary process, that inflation is declining. But we also look at the underlying inflation and what feeds some of these underlying inflation including in particular wages. So we also look at that because we want to be stable on 3 accounts: inflation outlook, underlying inflation, strength of transmission. On the latter, I think strength of transmission, we're seeing a good and solid transmission to the financing sector, and then further down the road to the economy. Thank you.
Thank you. And the last question goes to Jean-Philippe Lacour of AFP, Agence France-Presse. Jean-Philippe, please.
Jean-Philippe.
You have to unmute. We do not hear you.
We do not see you either.
We do not hear you, Jean-Philippe.
Good. Get rid of him.
I'm very sorry. I can see you, but nobody hears you.
You can seem not happy with this computer. That's obviously the case.
Yeah, whatever.
Okay, well, it will be next time, Jean-Philippe. So we come to the end of our press
Yay!
conference. Thank you very much for following.
Bad day for
Next
Jean-Philippe.
press
His
conference
boss is
will
going to be
on the 11th of
pissed.
April. Until then, all the best. Thank you.
All right. So anyways, look, the ECB said they didn't even discuss cutting interest rates, but they're not ready to. Whatever. Hey, they didn't talk about it, which means next meeting maybe they talk about it. So the next meeting they're not going to cut. Very interesting. So kick the can down the line. Well, that's the European way. Very cool. So anyways, tonight we are going to do a mini swing trading meeting, and then we are going to gather as a group to watch the State of the Union address. I'll make it available to everyone that is willing to pay $1. So I'll send out a general email, and I'll send you the invitation, and we can gather, and it's going to be casual. You don't have to wear a tie. I'll probably bring a bottle of whiskey with me. Yeah. And whatever. And we can watch it together. And it should be interesting. It should be fun. I can answer your questions. But mostly I think we'll just hang, watch it, and chit-chat. Does that sound like a good idea? Yeah. You won't have to be a member of QuantBox. You won't have to be a member of Investor Bootcamp. You won't have to be a member of anything. But there's a $1 cover charge. You have to put a tip on the plate. I'm just watching that pivot. Yeah, it's pretty late. That's what I mean. Like, if no one's going to show up, then what I usually do. Well, sometimes I watch it. Sometimes I research it in the morning. The thing is, it starts at 9, and I usually go to bed around 9 because I wake up so early in the morning to trade. So yeah. So I'll see if I can find some time to take a nap. But anyways, I'll let you go. It's going to be a busy day. The stock market's open. Lots to do. But make sure you watch your email for the invitation tonight. I'm assuming you're on the Investor Bootcamp email list. If not, well, for shame. Peace on earth. May the pips be with you. May your profits be above average. See you later.